Bismillahirrahmanirrahim. In this video, we will discuss how to analyze the relation between current ratio and operating cash flow to current liabilities ratio. So let us look into an exercise over here. A firm has experienced an increasing current ratio is increasing, but the operating cash flow is decreasing. Operating cash flow to current liabilities ratio is decreasing during the last 3 years. So, what is the likely explanation for these results? Now, we know that current ratio is current assets divided by current liabilities, and operating cash flow to current liabilities ratio is operating cash flow divided by current liabilities. And the likely explanation for the firm's increasing current ratio but decreasing operating cash flow to current liabilities ratio is that the company may be relying more on short term debt or other current liabilities to finance its operations. Now, this will definitely increase its current ratio, but it may not be generating sufficient cash flow from its core operations to meet these liabilities. That causes the operating cash flow to current liabilities ratio to decrease. Now, when we look at the current ratio, a increase in the current ratio indicate that the firm's current assets like cash, accounts receivable and inventory are increasing relative to its current liabilities, that is short-term debts and obligations. So this suggests that the firm has more short-term assets available to cover its short-term liabilities. Now, coming to the operating cash flow to current liabilities ratio, that is decreasing. A decreasing ratio suggests that the firm has, although increasing current liabilities, the liabilities are increasing, but its operating cash flow, that is cash that is generated from operations, is not growing sufficiently to cover these liabilities. So we have taken some hypothetical numbers over here for year number 1, 2, 3. We have the current assets, we have the current liabilities, and we have the operating cash flow. So the current ratio for the year number 1 is 500 divided by 250, so that is equal to 2. For year number 2, it is 600 divided by 300, that is again 2, and 700 divided by 350, again the ratio is the same, 2. So what we can see is that the current ratio remains the same, and this is due to the consistent increase in the current assets, you can see over here, as well as current liabilities are also increasing during this period. So that's why they are able to maintain the same ratio over the years. Although in this example, in this specific example, it remains stable, that is 2 for each year. In practice, this may increase further. Now, coming to operating cash flow to current liabilities, operating cash flow to current liabilities ratio for the year number 1, it is operating cash flow is 100,000 divided by the liabilities, that is 250. So 100 divided by 250, this is equal to 0.4. For year number 2, it is the 120 divided by 300, this is again 0.4. For year number 3, it is 100 divided by 350, that is equal to 0.286. So here we see that the operating cash flow to current liabilities ratio has decreased from zero point 0.4 in year number 1, and year number 2 is the same, but in year number 3 to 0.286. Now, despite an increase in the operating cash flow in year number 2, So this suggests that although operating cash flow grew slightly in year number 2, the growth in current liabilities is increasing by 550,000 each year, and this has outpaced the operating cash flow growth. In year number 3, you can see that the operating cash flow actually decreased while the current liabilities they continue to rise, which lead to decline in the ratio. So to conclude, the current ratio can be increasing if the firm is accumulating more short-term assets like cash or receivables, or increasing credit from suppliers. However, the operating cash flow to current liabilities is decreasing because the operating cash flow is not growing enough to cover the increasing short term obligations. The company may be relying more on debt, that is current liabilities, but it isn't generating enough cash from its operations to meet these obligations. In practice, this could be a sign that while the company looks more liquid on paper due to the increasing current ratio, it may be facing a cash flow problem if this trend continues. So we hope we are able to clarify how to analyze the relation between current ratio and operating cash flow to current liabilities ratio. So this completes the video on how to analyze the relationship between current ratio and operating cash flow to current liabilities. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. We hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe and share my channel and hit the notification bell button to alert you for the latest video. For all of your questions, comments and suggestions, please put them in the comment section below, and for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is a K. Thank you so much and happy learning.